Good morning, this is Ken Long from Tortoise Capital with the review of the weekend trading report for December 14th, 2013. We have a market that is in bullish, quiet conditions on an annual basis using weekly RSI 14. We're at 67 out of 100, so at the high end of neutral. It has pulled back from overbought conditions from last week. On a 10-day basis using the 10-day NDX, we are at oversold conditions at 9 out of 100. Looking at the market mosaic, price relative to the 200-day moving average has pulled back to red bullish at 7.44%. So we have a 5.5% cushion between here and sideways markets. Slope of the 50 remains bullish, white bullish at 0.58. ADX has declined to 20, so we are neutral with respect to trendingness. ATR percentage remains incredibly low, 0.67 for quiet. The risk index is the 30-period moving average of the VIX divided by the 10-period. It comes in at a score of 0.92, so we are in risk-off conditions, meaning that riskier assets are not favored. When you take that score of 0.92 and compare it to the last 5,000 trading days, that comes in with a z-score of minus 1.08. You can see the 90-day time series of that indicator plotted on the histogram, and we're moving towards extreme low reading on the risk off. This would be a natural place for a reversion to the mean and a continuation of the bull market. Blended monthly rebalancing, no changes to the ETF 13, 22, and 32 portfolios, with the next reevaluation being due on or about 1 January. Theoretical exposure in the ETF2 model is at 60%, and the model portfolio itself will be at 100% exposed with the stops in place. Looking at the ETF 13 and 32 portfolios for current holdings, it's in the 13, it's NASDAQ, small caps, large caps, mid caps, so it's all US all the time. Europe went to a cash position, and about half of the portfolio choices are on a cash position, and that's priced with respect to the 4-month moving average. In the 32 ETF, it's still the same kind of story, with the US dominating with technology, industrials, and consumer discretionary in the top. And again, about half the choices are on cash positions, really being dominated by globals in this case, with global weakness. Looking at ETF Max, or the 1,500 ETFs in the master database, Solar ETF TAN comes off a buy position into cash as it drops to position number 4. Its 3-month gains are still significant, still in the green, but price with respect to the 4-month moving average it dropped down below, and that's about the 3rd week we've seen with pullbacks in TAN. And in the ETF2 portfolio, fortunately, our 10% stop did what it's supposed to do and protected the outside profits. And you can see the remainder of the top 50 leaders here. Looking at the market health check, the solid blue, dark blue is the 30-period Bollinger Band plus or minus 1, the river. The light blue is 30-period Bollinger Band plus or minus 2, and that's the floodplain. Hey, Rex, get the door! Get the door, I'm on the... We have the vertical blue lines here being 10, 20, and 30 days worth of look back. The light blue channel here is a 10-period regression line channel formed by the maximum excursion from the regression line during the look back period. So that 10 period is sloping down, and we're in the bottom half of that, so we're testing important support levels at the edge of the river. The 30-period regression line is sloping up but starting to decay with respect to the 90, so we're slowing down the gains of the bull. And you can see really over the last 20 days we've been in a sideways quiet channel here, and we're testing very important support levels. Now it's held 2 days in a row at that key 178 price level at the bottom near the bottom of the river, near the Bollinger Band mean, and at the bottom of the 30-day channel. So let's see if we hold support here. The slope of the 30 is still up, but you can see in this sine wave indicator, the time series of that slope, it's pulling back closer towards the zero line than the extreme upward reading. So again, we're at very crucial support levels here. The fact that we haven't had any panic selling except for one day of big down, I still consider to be favorable, and this is a good buying opportunity. But let's see some evidence of reversion to the mean. The last time we saw a 20-day period that was sideways, we don't really get until back here in late August, and you might argue a little bit in here in October. In both cases, the bull came through, so we're looking for some strength here at those key support levels. But if 178 fails, then it's these next red lines on the way down with support at 175, 73, and 70. You can see how the 200 period moving average is just kind of relentlessly marching along here. As the bull is slowly running out of steam, the 200 is catching up. Still about a 4.5% cushion. Now the jaws of percent price oscillator are open to the downside, and on a Williams percent hour we're oversold, so we're going to have a lot of channeling and overreaction signals. And this will, if 178 holds, this will be a great opportunity to buy quality at value. But we are at a critical state here with a pullback that has ended in a doji at a natural support level, which we want to see hold. If it fails, then let's look out below with these red lines giving you price targets and support levels on the way down. In the ETF2 regional summary, we've got 6 out of 10 indexes are on a cash position, puts the theoretical model at 60% invested, 40% cash, down from 80-20 last week. The S&P at a score of 82 is still better than EFA at a score of 80, so it's the U.S. over the globals. Inside the U.S., it's technology at 86, small caps at 83, large caps at 82, mid caps at 82 in terms of relative strength. The two strongest sectors in the world are U.S. tech and the Russell small caps. Two weakest remain Latin America at 73 and Asia less Japan at 75. You can see that the strength inside of the S&P sector spiders remains with industrials and consumer discretionary, with weakness in utilities, which is now on a cash position. In the world market model, everything in the U.S. is above average, with the large and small cap growth exceptionally strong. China remains exceptionally strong, along with Hong Kong, Malaysia, Taiwan, South Korea, and India. Laggards, Thailand, Philippines, Indonesia. Japan is above average, but Asia less Japan below average. Brazil and Latin America just suffering. Inside the other asset classes, it's the private equity standing out, but otherwise extreme weakness, oil, gold, silver, and weakness in the fixed income areas. Everything Europe remains above average, although you're starting to see some weakness creep in with Britain and Sweden, but Germany and Spain continue to lead the way. Slight advantage to the U.S. in business sectors compared to their global counterparts, with a couple exceptions, but discretionary and industrials again leading the way. ETF top 30. We like the green on strength, white on consistency as an indication of emerging relative strength short term, which really outperforming, and it's been above average longer term on the 10-week moving average. So that's areas that are looking strong. So things like regional banks, the internet index, pharmaceuticals, and again, look at technology. The U.S. tech, the Q's in the top 15 here, really quite remarkable performance. Natural gas at one-time spike, it's green and yellow. You see that very rarely. That spike could be over, however. Looking at the Dow 30 through that same lens, Boeing remains at the top of the stack, just with an exceptional performer here. Nike also looking powerful, and then General Electric, American Express, Visa, and Microsoft all in that favorable green and white condition. but weakness here in United Health, which is yellow and then white. So that's an evidence of weakness, as is IBM with red and yellow. We're now up to about 7 symbols on their that are on a cash position in the Dow. So some weakness starting to creep in across all the indexes. We'll shift now to the daily report. Plenty of channeling and overreaction signals, as we've noted earlier, based on market conditions. A ton of them in the large caps and in the ETFs. 5DD in Europe and the Euro Asia blend. Triple screen in Merck. Good quality symbols here in 551W on both the ETF and the large cap side, and then a ton on the auto framer that test out better than 2 to 1. In the Dow Tactical, as you can see, plenty to choose from. Lots of symbols firing on the RSI2. So we're right in our wheelhouse with respect to swing trading a day at a time, or swing trading and getting well started on day one. Lots of dojis, a ton test out at better than 2 to 1 on the auto framer. Johnson & Johnson should be on your list. It's a doji. It's channeling an overreaction. It's number 3 on the max pain range compression. It's 3 1/3 to 1 on the auto framer. It's very froggy as well. Same story in the ETFs. Plenty of dojis. Lots of channeling and overreaction. A 5DD in Europe and the Euro Asia blend, which had the added advantage of being in the top 5 for max pain range compression and test out very well on the auto framer. Again, half a dozen symbols firing on the RSI2. In the auto framer, just some reference stats for those of you mechanically framing those trades. And the rest of the charts just for reference purposes. You can notice the weakness across the board in the Z-scores of swing gains. So this is a market-wide phenomenon, this recent pullback. Now, in the Z-scores of the regression line slopes, this is useful here. We finally got this pullback to near the bottom of the river, and but the 90-period regression line slope is still very strong. So this is a measured pullback, and both the 30 and the 10 regression lines slopes have pulled back into the river, with the 10 closer to oversold, near the normal oversold. And after these previous pullbacks on the 10, you can see how it has responded with sharp upward moves in the past, and so that creates the technical support here for potential upward moves. The 30 has cooled off quite a bit. We've seen, basically being sideways for the last 20 days. So now we've created the investable moment that can get us back, I think, 4 or 5 points up to 185 just on a normal rebound. So we'll be looking for that. And that's everything I want to cover on the daily report. I'll flip through the rest of the slides for you for reference purposes. And thanks for your kind attention. Have a good holiday season, and we'll see you in the chat room on Monday.